Welcome to the Deep Dive, brought to you by Beyond Backtesting's Trading Podcast.
Great to be here.
Today, we're embarking on a pretty ambitious journey, actually. We're doing a deep dive into what we think is the world's most essential trading literature.
Yeah, it's quite a list we've put together. 30 books.
Exactly, 30 highly recommended books. And they cover, well, everything from the foundational mindset stuff, market narratives, all the way to cutting-edge machine learning and finance.
Importantly, performance psychology, too. Can't forget that.
Absolutely crucial.
No.
So our mission for you, our listener, is, well, it's audacious. We want to extract the most unique, the most proprietary, the most actionable insight.
The goal being what, like 95% of the value?
That's the aim. 95% of the value you'd get from reading and studying all these books yourself, but, without the information overload.
Think of it as a curated tour.
Exactly. A comprehensive tour through the minds of legendary traders, pioneering quants, basically designed to equip you with the knowledge to navigate markets with, well, more confidence.
And you don't have to read all 30, right? We're pulling out the highlights.
Precisely.
Yeah.
No need unless you really want to. We're pulling out the absolute must-knows, those real aha moments, and the unique perspectives you probably won't find just anywhere else. Okay, let's unpack this.
Yeah, and that unpacking, I think that's key, because a structured learning path is just so critical in a field as complex as trading. It's really demanding.
It really is.
And it's not just about what books are on the list, but really digging into why these specific ones are either foundational, the bedrock, or why they're truly cutting edge right now.
Right, it's the why.
Because true mastery, it doesn't come from just knowing, say, quant methods. It really emerges when you synthesize knowledge across these different areas: psychology, quantitative methods, technology.
They all connect.
Exactly. So we've organized this deep dive into 5 core categories to make it logical. We start with foundational mindset, then the psychological edge, then systematic and quantitative trading, then algorithmic trading and high-frequency insights, and finally, we get to machine learning and finance.
So it builds layer by layer.
Precisely. Designed to build your understanding logically, tackling the human side, the analytical rigor, and the tech frontier.
Okay, sounds like a plan. So we're starting at the very beginning, the bedrock principles, the enduring human element that, well, frankly, shapes the markets.
Yeah, the timeless truths.
These aren't your typical how-to guides, telling you exactly when to buy or sell. They're more like, well, how to think guides, laying that essential mental groundwork.
Couldn't agree more. Critical foundation.
All right, first stop. Reminiscences of a Stock Operator by Edwin Lefebvre, a classic, fictionalized bio of Jesse Livermore.
Legendary. Maybe infamous, too.
Maybe a bit of both. But the insights into speculation are timeless. One of Livermore's most powerful lessons, I think, and maybe slightly overlooked sometimes, is his intense focus on the point of least resistance.
Explain that a bit.
Well, he wasn't just watching price. He was observing how price moved. Did it continue easily in one direction? That signals real momentum. Or did it hit resistance, suggesting maybe a reversal?
So the character of the movement, not just the level.
Exactly. It wasn't about predicting every little wiggle. It was about discerning the underlying market current, knowing when the path was clear or when it was, full of obstacles.
Like feeling the market's flow.
Precisely. And this ties into his other big insight. Price action is the ultimate truth. Respect the tape, as they used to say. Divorce your opinions from what the market is actually doing.
Which is so hard for people to do.
Incredibly hard. But focusing purely on price action, on volume, not what it should be doing or what some analyst says, that leads to clearer decisions. The tape is the objective judge.
It's amazing, really. Decades ago, Livermore instinctively got what modern quants try to model now: order flow, microstructure, stuff that reveals genuine conviction.
Right. He understood that human emotions, greed, fear, hope, they're the constant drivers, despite all the technology. They shape those points of least resistance again and again. Nothing new on Wall Street, he said.
And that fear and hope, his other big point, right? A trader's greatest enemies.
Absolutely. Hope makes you hold losers too long, praying they'll come back. Fear makes you cut winners too short, terrified of losing profits. Conquering those is more critical than almost any analytical skill.
And the final piece from Livermore: The big money.
Yes. The big money isn't in the day-to-day fluctuations, the noise. It's in capturing the major trends. He stressed patience sitting tight to ride those large movements is ultimately more profitable than constantly chasing small moves.
Which requires incredible discipline.
Totally. It shifts your whole mindset from predicting every tick to identifying those broader currents.
Timeless wisdom. Okay, what's next?
Next up, we dive into Market Wizards, interviews with top traders by Jack Schwager, another absolute classic. It's a goldmine, really, showing just how diverse the paths to success are.
Yeah, so many different styles represented in those interviews.
Exactly. Discretionary, systematic, macro, micro. You name it. And Schwager's key insight, I think, is that every successful trader finds a method that genuinely fits their personality.
That's crucial. You can't just copy someone else's system if it doesn't align with how you think, how you handle stress.
Right. Trying to force a strategy that doesn't match your psychological makeup is just a recipe for disaster. You need that self-reflection. What are your strengths, your weaknesses?
And beyond finding your fit, what's the universal truth Schwager found?
The non-negotiable. Rigorous risk management. This is the thread connecting all the wizards. Capital preservation is paramount.
You can't play if you're out of the game.
Precisely. And it's not vague, they talk specifics. Quantifying risk per trade, often as a fixed percentage of equity, maybe 1% or 2%, or defining their stop loss as 1R, a specific unit of risk.
That quantification is so important. It's not just don't lose too much. It's a precise mechanism.
Exactly. It links potential loss directly to overall capital. It makes capital preservation mathematical, almost automatic. That's how they survive drawdowns. Losses become a calculated cost of business, not a personal failure.
Which frees you up mentally to focus on good execution, knowing the downside is controlled.
And tied to that is discipline, patience, and the ability to take a loss. That emotional resilience. Successful traders see losses as just part of the game, not a reflection on them. They stick to the plan even when it's hard.
The psychological fortitude.
And one more thing from Wizards adaptability. The best traders aren't rigid. Markets change, so strategies have to evolve.
Right. Clinging to something that stopped working is dangerous.
Totally. Continuous learning, self-correction, adapting to new market realities. That's vital.
Okay, so we've got timeless human nature from Lefebvre, diverse paths, but universal risk control from Schwager.
Yeah.
Where to next?
Next, we tackle Nassim Nicholas Taleb's Fooled by Randomness. This one's more philosophical, but incredibly important for anyone in markets.
Taleb. Always makes you think. And challenges assumptions.
He certainly does. He forces us to be deeply skeptical of narratives, especially the ones we tell ourselves. His big concept here is the narrative fallacy.
Right, how our brains are wired to invent stories, to explain things, even random outcomes.
Exactly. We see patterns when none exist. We attribute skill to luck or luck to skill. And in trading, that self-deception can be fatal.
So what's the antidote?
Instead of asking, why did I win? Or why did I lose? And making up a neat little story, Taleb says, focus relentlessly on your process, your methodology.
Because individual outcomes are noisy.
Precisely. If you have a statistically sound edge, it plays out over a series of trades. Single results are random noise. But a robust process applied consistently with solid risk management, that's what delivers long-term positive expectancy.
It forces detachment from the emotional ride of each trade, grounds you in statistical reality. Let the edge play out over the long run.
And related to that is distinguishing between noise and signal. So much market movement is just random fluctuation. The trick is filtering for the meaningful information, the true signals. That's fundamental for building robust strategies and avoiding, overfitting to noise.
Absolutely critical for system design.
And Taleb also warns us about gurus and experts. Be wary, question their track records.
Would just be a lucky streak, right? Survivorship bias.
Exactly. You need skepticism. You need rigorous statistical proof before you just believe someone has skill. Don't get fooled by randomness, basically.
Healthy dose of skepticism is always good in this business.
Couldn't agree more. Okay, final one for this foundational section. One good trade. Inside the highly competitive world of proprietary trading by Mike Bellafiore.
SMB Capital. A very practical, real-world perspective.
Yeah, Bellafiore co-founded a prop firm, so he gives this really grounded look at what it takes. His most actionable insight, I think, is the concept of building and meticulously maintaining a playbook of mastered setups.
Okay, tell me more about the playbook concept. It sounds specific.
It is. It's not just a trading journal. It's a living document. It contains repeatable, high-probability patterns or setups that you, the trader, have thoroughly studied, back-tested, practiced, basically mastered.
So like your go-to moves.
Exactly. Each entry details the conditions for entry, the exit strategy, the risk management rules, and crucially, the post-trade analysis for that specific setup.
I see. So it systematizes discretionary trading in a way.
That's a great way to put it. Your edge isn't some magic intuition. It's the repeatable execution of these well-documented, mastered setups in your playbook. It builds real confidence because it comes from deep understanding and consistent application.
And that ties into his idea of focusing on one good trade at a time, right?
Precisely. Focus on the quality of execution for this trade based on your playbook, rather than obsessing over the grand P&L. Success is built trade by trade through preparation, review, constant feedback loops.
Like an elite athlete reviewing game film.
Exactly. Trading as a performance business, pre-market routines, detailed journaling, dissecting every trade wins and losses for lessons. That's how you build that proprietary knowledge.
And he also stresses the environment, doesn't he?
He does. The value of being around other serious traders, that professional environment, peer feedback, shared learning. It accelerates skill development and builds mental fortitude. You push each other.
Right. So those first four really set the stage. Timeless human nature, the need for personal fit and risk control, understanding randomness, and the practicalities of building an edge through process and review.
Yeah, they establish the mental architecture you need before diving into the more technical stuff. It's the foundation.
What's fascinating here is how these seemingly simple narratives, these stories, reveal such deep, enduring truths about market dynamics and human behavior.
Absolutely. Okay, so foundation laid. Now we pivot. We pivot to what many, including myself, consider the single most critical factor for consistent success: mastering your own mind.
The psychological edge.
Exactly. This section goes deep into trading psychology, moving beyond just anecdotes to hopefully actionable mental strategies that can genuinely transform your performance.
This is often the biggest hurdle for traders.
Without a doubt. First up here, The Giant. Trading in the Zone by Mark Douglas, arguably the most important book on trading psychology ever written.
Agreed. It's foundational for mindset.
Douglas argues that consistent success comes from a profound mindset shift. He kind of liberates traders from the impossible burden of prediction.
How so?
His core insight, the one that changes everything if you truly internalize it, is this: you don't need to know what will happen next. You only need an edge with positive expectancy over a series of trades.
The probabilistic mindset again.
Exactly. It reframes trading entirely. It's not about predicting the future, which is impossible. It's an exercise in probability management. The key isn't being right on this specific trade. It's about consistently executing a statistically favorable process.
Which means any single loss is meaningless in isolation.
Precisely. It's just one random outcome in a series where your edge, assuming you have one and stick to it, will eventually manifest over enough trades. It takes the pressure off being perfect.
That's huge. It shifts the focus from results, which are noisy, to process, which you can control.
And tied to this is taking absolute responsibility. You are solely responsible for your results. No blaming the market, the news, your broker.
That's the first step to empowerment, right? Taking ownership.
Absolutely. And then there are his 5 fundamental truths about the market. Things like, anything can happen. You don't need to know what's going to happen next to make money. There's a random distribution of wins and losses for any given edge.
An edge is just a higher probability of one thing happening over another.
Right. And every moment in the market is unique. Internalizing these creates tremendous mental flexibility. It stops you from thinking in rigid certainties.
And the final piece from Douglas: risk acceptance.
Yes, true acceptance of risk, which means being genuinely okay with any outcome of a trade before you even put it on, mentally preparing to accept the loss before it happens.
So you don't freeze up or make irrational decisions during the trade if it goes against you.
Exactly. It prevents that emotional hijacking. Powerful stuff.
Really powerful. Okay, who's next in the psych lineup?
Our next crucial guide is The Mental Game of Trading by Jared Tendler. He's a performance coach, known for working with top poker players, and he brings that structured approach to trading.
Right. More systematic than Douglas, perhaps.
Yeah, very structured. His most powerful insight, I think, is that emotions like fear, greed, or frustration are signals of underlying flaws, not the problem itself.
Okay, unpack that. That sounds counterintuitive.
Well, instead of just fighting the feeling of greed, Tendler teaches you to use it as a diagnostic tool. When you feel that greed or fear or tilt, ask, what's the root cause here?
Interesting. So what could the root cause be?
It could be anything. Maybe you don't have a clear trading plan. Maybe your position sizing is off. Maybe you hold a limiting belief about the market or yourself. Maybe you're just tired or stressed.
So the emotion is like a check engine light.
Perfect analogy. It's a signal that something needs investigating. Tendler advocates creating a mental hand history, like poker players do. You systematically map your emotional patterns, the specific situations that trigger them.
So you get tangible data on your own psychology.
Exactly. Systematic self-analysis to reveal hidden biases, weaknesses in your approach, recurring error patterns. Then you can develop a logical, repeatable process for working on that specific flaw.
Applying the same rigor to your mental game as you would to back-testing a strategy.
Precisely. And he also makes a great point about progress not being linear. Don't aim for a perfect A-game performance all the time. Aim to build a consistently higher C-game.
Meaning, raise your baseline. Perform better even on your off days.
Yeah, small, consistent improvements over time. Focus on raising the floor, not just chasing the ceiling. Very practical advice.
Very practical. Okay, Tendler gives us structure. Where do we go next?
We go to a Nobel laureate, Daniel Kahneman, and Thinking, Fast and Slow. Not strictly a trading book, but absolutely essential.
Absolutely. Understanding how our own minds work or often don't work rationally.
Exactly. Kahneman explores System 1, our fast, intuitive, often biased thinking, and System 2, our slower, deliberate, logical thinking. The key for traders is understanding when System 1 is likely leading you astray in the complex world of markets.
And consciously engaging System 2.
Right. You need to know when to slow down, analyze, and override those gut reactions that might be based on cognitive biases.
And he details so many relevant biases.
Oh, yeah. The big one for traders has to be loss aversion. The psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain.
Which explains so much irrational trading behavior.
It really does. It's why traders desperately hang on to losers, hoping to avoid the amplified pain of realizing the loss.
And why they snatch profits too quickly, terrified of seeing that pleasant feeling evaporate.
Exactly. Understanding this fundamental asymmetry is the first step. Then you can implement strategies to counteract it.
Like predefined rules.
Precisely. Using things like pre-trade checklists, objective entry and exit rules, structured review processes. These are tools to force your System 2 logic to override System 1's emotional biased reactions.
Fighting bias with process.
And another big one Kahneman discusses is confirmation bias.
Ah, yes. Seeking out information that confirms what we already believe.
Right. Traders do this all the time, only looking for news or analysis that supports their current position, ignoring contradictory evidence. Fatal in dynamic markets.
You have to actively seek out reasons why you might be wrong.
Exactly. Kahneman's work gives you the vocabulary and the framework to understand why your brain does these things, which is the first step to mitigating them.
So Douglas gives the mindset, Tendler the structure, Kahneman the bias awareness. A powerful trio for the mental game.
Definitely. Mastering psychology isn't about eliminating emotions. It's about understanding them, channeling them, and building processes to manage their impact.
Yeah, this raises an important question. How do these universal cognitive biases, like loss aversion or confirmation bias, manifest specifically in the rapid-fire, high-stakes environment of modern trading? It's one thing to know about them, another to manage them under pressure.
That's the million-dollar question, isn't it? Okay, so we've tackled the mindset, the psychology.
Yeah.
Now we transition. We move from the inner game to the systematic game.
All right, getting into the rules-based, data-driven approaches.
Exactly. Moving from intuitive decisions, which we now know are fraught with biases, towards building the actual trading engine based on rules and data.
Let's dive in.
First up, a very practical starting point. Quantitative trading. How to Build Your Own Algorithmic Trading Business by Ernest P. Chan.
Ernie Chan. Very accessible guides for aspiring quants.
Yeah, he makes it understandable for the retail trader. His most critical insight, I think, is that profitable strategies need both sound economic intuition and rigorous backtesting that accounts for real-world costs.
The twin pillars.
Yeah.
Can't just have one.
Right. It's dangerously easy to curve fit or data snoop, torture the data until it confesses, basically. Find a pattern that looks amazing historically.
But has no actual predictive power going forward.
Exactly. Because there's no logical reason why it should work. No economic intuition. It was just a random pattern in past data. Chan stresses you need a reason, a hypothesis, before you start testing.
Avoid spurious correlations. And the second part, the costs.
Crucial. Proper backtesting must account for transaction costs, commissions, fees, and especially slippage.
That difference between your expected fill price and the actual price.
Even tiny costs per trade add up massively and can completely wipe out the edge of a strategy that looked great in a frictionless backtest. You have to be realistic about these real-world
It
frictions.
separates the backtest heroes from the real money traders.
Definitely. He also introduces the Kelly criterion for position sizing.
Ah, the optimal betting size formula.
Right, but he stresses using it with caution. Always use fractional Kelly. Never bet the full calculated amount because real-world parameters are uncertain. It avoids over-leveraging and blowing up.
Prudent advice. Kelly can be dangerous if applied too aggressively.
And one more hopeful point from Chan. Individuals can still exploit niches too small for the big funds.
Like less liquid markets or specific ETFs.
Exactly. Areas where large institutions can't deploy significant capital due to scale limitations, that's where a potential retail edge might still exist.
Interesting. Okay, so Chan sets the practical foundation for quant trading. Does he get more specific?
He does in his next book, Algorithmic Trading, Winning Strategies and Their Rationale. Here he delves deeper into specific strategy types.
Like mean reversion and momentum.
Precisely. He highlights that mean reversion and momentum are robust, persistent market anomalies, but their effectiveness is highly dependent on the market regime.
Okay, explain regime.
A market regime is just the current overall market environment. Is it trending strongly? Is it choppy and range-bound? Is volatility high or low?
Got it. So a strategy's performance isn't static.
Not at all. A mean reversion strategy might thrive in a choppy market but get killed in a strong trend. A momentum strategy needs trends to work. The key insight is you need to identify the current regime and potentially adapt or switch strategies accordingly.
Avoids that dangerous rigidity, trying to force a strategy when the environment isn't right for it.
Exactly. He also gets into more technical concepts for specific strategies, like using cointegration for pairs trading.
Ensuring the two assets in a pair have a statistically stable long-term relationship.
Right. It's the statistical property that keeps pairs trades from just blowing up randomly. It prevents you from trading two things that just happen to look correlated for a while but have no real underlying connection.
Crucial for robust mean reversion strategies between assets.
And finally, Chan stresses that no strategy lasts forever. Edges decay, markets change, other traders crowd the strategy.
So you need constant monitoring.
Constant monitoring, out-of-sample testing, and the discipline to retire a strategy when the edge genuinely disappears. Don't fall in love with your algorithms.
Brutal but necessary advice.
Oh.
Okay, Chan gives us the strategies and the need for adaptation. What about the market itself?
Excellent transition. For that, we turn to Trading and Exchanges. Market Microstructure for Practitioners by Larry Harris. This is the Bible on how markets actually work under the hood.
The plumbing of the market.
Yeah.
Essential for algos.
Absolutely essential. Harris's core insight, especially relevant for algorithmic traders, is that understanding order types and their impact on liquidity and the order book is fundamental for high-quality execution.
Beyond just finding an edge, how do you actually capture it efficiently?
Precisely. It's not enough to have a signal. You need to understand the trade-offs. Do you use a market order? You get speed, but you might pay a high price in slippage, especially in thin markets.
Versus a limit order.
Right. A limit order guarantees your price, or better, but you risk not getting filled at all if the market moves away. Your choice profoundly impacts your transaction costs and overall profitability.
And this ties into liquidity.
Directly. Harris hammers home that liquidity. The ease of buying or selling without significantly impacting the price is arguably the most important characteristic of a market for a trader. Illiquidity is costly.
And it's related to information asymmetry.
Yes. He explains adverse selection. That's the risk liquidity providers, like market makers, face when they might be trading with someone who knows more than they do.
The informed trader problem.
Exactly. The bid-ask spread is, in large part, compensation for taking on that risk. Understanding this dynamic helps you understand why spreads widen or narrow, and how your own orders interact with this flow.
So market structure itself impacts your strategy's viability. Different exchanges, different rules.
Absolutely. Order-driven markets versus quote-driven markets, auction processes, they all influence price behavior, liquidity, and ultimately your bottom line. You need to understand the mechanics of the venue you're trading on.
Deep stuff. Okay, one more in this section.
Yes, one more, and we circle back to Taleb with Anti-Fragile. Things that gain from disorder, possibly his most important work for traders, I think.
Moving beyond just robustness.
Exactly. Robustness is about surviving shocks.
Hmm.
Anti-fragility is about benefiting from shocks, from volatility, from randomness, from disorder, getting stronger when things get chaotic.
How does that apply practically to trading system design?
Taleb's truly proprietary insight here is the barbell strategy. It's a concrete way to build anti-fragility.
Okay, the barbell, how does it work?
You allocate the vast majority of your capital, say 80–90% hyper-conservatively. Think treasury bills, very safe assets, protect it rigorously.
Okay, the safe side of the barbell.
Then you take the small remaining portion, 10–20%, and allocate it hyper-aggressively to things with massive potential upside but limited downside, things that benefit from extreme, unexpected events.
Like out-of-the-money options or maybe venture capital type bets within a trading context.
Exactly. High potential, convex payoffs. The key is the maximum loss on the aggressive side is small relative to your total capital, but the potential gain from a rare black swan event hitting is huge.
So you cap your downside massively, but retain exposure to explosive upside from chaos.
Precisely. It's a way to structure your entire approach to gain from market disorder rather than just trying to predict it or merely survive it. It flips the script on risk management.
That's a very powerful mental model, beyond just diversification.
And it ties into his other point. Avoid complex, fragile models that create illusions of control. Simplicity and robustness, or better yet, anti-fragility over intricate, opaque designs that can shatter in unexpected ways.
And the via negativa idea.
Right. Success often comes more from what you avoiding ruin, avoiding fragile strategies, avoiding unmanageable complexity than from chasing every last bit of potential upside. Focus on eliminating the downside first.
Powerful concepts. So, if we connect this section, we've gone from the practicalities of quant trading with Chan to the market mechanics with Harris and ended with Taleb's philosophical approach to thriving in uncertainty.
Yeah, it shows how building effective systems requires both a deep understanding of the market's plumbing and a robust, almost philosophical stance against the inherent randomness and potential chaos.
Okay, where does this deep dive take us next?
Now we get into the really high-tech stuff, the technological and structural realities of modern high-speed electronic markets. Finance meets cutting-edge tech. The electronic frontier.
HFT, algorithms, the speed game.
Exactly. We kick off with The Man Who Solved the Market by Gregory Zuckerman. This is the story of Renaissance Technologies' Jim Simons, the ultimate quant fund.
The Medallion Fund. Legendary and famously secretive.
Extremely secretive. The most revelatory insight from Zuckerman's book, I think, is how RenTech found its edge. Powerful edges were often discovered in very short-term, statistically significant patterns that were incredibly hard, if not impossible, to explain with traditional financial theory.
So not based on fundamentals or economic narratives.
Largely not. They focused on finding these micro patterns, these tiny, fleeting statistical anomalies that traditional analysts just couldn't see or wouldn't look for. It was pure statistical arbitrage driven by brilliant mathematicians and scientists, not finance PhDs.
They famously hired codebreakers, physicists.
Right. And their success proved a controversial point. If the numbers work consistently, if the statistical edge is robust and persistent across different regimes, the why, the fundamental story, might actually be secondary for trading. It's pure empiricism.
Which requires incredible infrastructure.
Oh, absolutely. Huge volumes of clean, granular data and massive computational power became the cornerstones. It kicked off the arms race in data and computing that continues today.
And the culture was key too, wasn't it?
Definitely. Intense secrecy, but also intense collaboration among the scientists inside the firm. A unique environment that fostered groundbreaking, unconventional research.
Fascinating story. Okay, from the pinnacle of quant success to maybe the darker side.
You could say that. Next is Dark Pools, The Rise of the Machine Traders and the Rigging of the U.S. Stock Market by Scott Patterson, a more journalistic, critical look at electronic trading.
Patterson focuses on HFT and market structure complexity.
He does. He vividly illustrates that the stock market isn't one big, unified entity. It's a highly fragmented network of dozens of exchanges and private trading venues. dark pools.
And this fragmentation creates opportunities and problems.
Exactly. Orders get routed across all these different locations based on complex rules, and in this fragmented world, speed becomes the ultimate weapon.
The latency game.
HFT firms spend fortunes, literally fortunes, on gaining microsecond or nanosecond advantages. Building microwave towers between Chicago and New York, laying specialized fiber optic cables just to shave off tiny fractions of time.
Why? What does that speed buy them?
It allows for things like latency arbitrage, detecting a price change or a large order on one venue and racing to trade on another venue before the rest of the market catches up. It's information arbitrage based purely on speed.
Creating a two-tiered market, some would argue.
That's the argument Patterson explores. He also delves into dark pools, private venues originally created for large institutions to trade big blocks without moving the market immediately.
But they raise transparency concerns.
They do. There's a constant debate about their fairness, their impact on public price discovery. It's all part of this ongoing cat-and-mouse game between market participants exploiting structural loopholes and regulators trying to keep things fair.
Complex ecosystem.
Very complex. And that leads us directly to Flash Boys, A Wall Street Revolt by Michael Lewis.
The book that really brought HFT front-running into the public consciousness.
It really did. Lewis tells a compelling story, focusing on how HFTs could systematically front-run large institutional orders across this fragmented market.
Explain that mechanism again, the latency arbitrage.
Lewis explains it clearly. An HFT firm detects part of a large buy order hitting, say, the New Jersey Bats Exchange. Instantly, their algorithm races ahead of the rest of that order via faster connections to other exchanges. NYSE, NASDAQ buys up the shares there and then sells them back to the original slow-moving institutional order at a slightly higher price, all in milliseconds.
Basically jumping the queue because they're faster.
Exactly. Profiting from privileged speed and knowledge of the market's plumbing. Lewis argues this complexity was creating opportunities for sophisticated, almost predatory exploitation.
And the physical infrastructure is key.
Absolutely. He highlights how even the physical length of a fiber optic cable or being physically closer to an exchange's matching engine becomes a competitive edge. Geography is destiny in HFT.
And the solution proposed in the book, IEX.
Right. The creation of IEX, the Investors Exchange, co-founded by the book's protagonists. Their innovation was a speed bump, a 350 microsecond delay deliberately introduced via coils of fiber optic cable designed to negate the speed advantage of the fastest HFTs and level the playing field for regular investors.
A market designed to fight back against latency arbitrage.
Exactly. It shows how market structure itself impacts execution quality for everyone, even retail traders. You need to be aware of these forces because they affect your fills.
Powerful narrative. Okay, so we've had the success story, the critical journalistic takes. What about the deep theory?
For the deep theory, we have Market Microstructure Theory by Maureen O'Hara. This is the canonical academic textbook. Dense, but foundational.
The bedrock theory behind Harris's practical guide.
Precisely. O'Hara delves into the economic models that explain how markets work at the most granular level. Our key insight is that price discovery is a dynamic process of information aggregation, fundamentally shaped by adverse selection.
Information getting incorporated into prices through the act of trading itself.
Exactly. The market is like an information processing machine. Trades reveal information, maybe someone knows something and prices adjust, but this creates the risk of adverse selection for liquidity providers.
Right, the risk of unknowingly trading with someone who has an informational edge.
And O'Hara shows mathematically how this risk is a key determinant of liquidity and the size of the bid-ask spread. Market makers price that risk into their quotes.
It connects information, risk, and transaction costs.
Beautifully. She also explores inventory models, how dealers manage their own risk by controlling the inventory of assets they hold, which influences their quoting behavior.
So their own risk management affects the prices we see.
Yes. And ultimately, O'Hara demonstrates how market design, the specific rules, protocols, and structure of an exchange profoundly affects market efficiency, liquidity, and stability. These rules aren't arbitrary. They have deep economic consequences.
So understanding this theory helps you understand why different markets behave differently.
Exactly. It provides the fundamental why behind the market mechanics we observe.
Okay, so take it together. These books on the electronic frontier paint a picture of markets driven by speed, complex structures, information asymmetry.
And powerful statistical models. It's a very different world from Livermore's time, even though the human emotions are still there.
Yeah, this raises an important question. How do these realities of modern market structure, the fragmentation, the speed game, the microstructure details, how do they directly inform the design and deployment of successful algorithmic trading systems today? It's clearly not just about finding a statistical edge anymore.
That's the perfect segue, because now we conclude our initial 20 books by diving into the absolute bleeding edge, applying artificial intelligence and machine learning directly to financial prediction and trading.
Right, the ML revolution in finance.
This is where the future of systematic trading is really being forged. It's transforming how we find opportunities, how we manage risk, everything.
Where do we start?
We have to start with Advances in Financial Machine Learning by Marcos Lopez de Prado. This is the definitive, rigorous guide. De Prado is brilliant, and he systematically dismantles many common, flawed ML practices in finance.
He's known for being quite critical of naive approaches.
Very critical, but constructively so. His most crucial insight is that financial data has unique properties non-stationarity, low signal-to-noise that makes standard ML techniques often fail disastrously. You can't just import a standard algorithm from image recognition and expect it to work on market data.
Why not? What's so different?
Financial data is non-stationary. Its statistical properties, like mean, variance, change over time. Market regimes shift, relationships break down. Standard ML assumes stationarity. Also, the signal-to-noise ratio is incredibly low. Finding true predictive patterns amidst the randomness is extremely hard.
So standard techniques overfit easily or find spurious patterns?
Exactly, and the data is sequential, creating autocorrelation issues. De Prado argues you need specialized techniques. One key area he focuses on is proper backtesting, advocating for methods like purged k-fold cross-validation.
Okay, that sounds technical. Why is it important?
Because traditional cross-validation methods used in other ML fields can suffer from data leakage in finance. Your model might inadvertently get trained on information from the future relative to the point it's trying to predict, making it look artificially good in the backtest.
Ah, so it looks profitable but wouldn't be in real life.
Precisely. De Prado's method involves purging overlapping data samples between the training and testing sets, and using a walk-forward approach to ensure the test is realistic and simulates how you'd actually trade. It's vital for avoiding strategies that only work on paper.
Rigorous validation is key. What about using ML for actual signals?
De Prado introduces innovative ideas there too, like meta-labeling. Instead of using ML to predict direction up-down, you use it to decide how much to bet on a signal generated by another, perhaps simpler model.
So ML for optimizing position sizing and risk, not just the entry signal.
Exactly. It's a clever way to leverage ML's power for risk management and bet sizing, which can be just as important as the signal itself. He also emphasizes using ML for dynamic feature importance, figuring out which inputs are currently most predictive, allowing for adaptive strategies.
Fascinating. De Prado sets the high bar for rigor. What about more hands-on guides?
For a practical, hands-on approach, we have Machine Learning for Algorithmic Trading by Stefan Janssen. This one is packed with Python code examples.
Getting into the implementation details.
Yeah. Janssen's key insight, I think, is the immense power of alternative data in providing a significant edge, coupled with the critical importance of feature engineering.
Alternative data things beyond standard price and volume.
Right. Satellite imagery of parking lots to gauge retail activity, credit card transaction data, shipping manifests, news sentiment analysis, web scraping, unique data sets that can offer insights before they hit the mainstream news or financial reports.
The new frontier for alpha.
Potentially, yes. But raw alternative data is often messy, unstructured, and requires significant work. That's where feature engineering comes in. Janssen emphasizes this is one of the most critical steps.
Transforming that raw data into meaningful inputs for the ML model.
Exactly. It's an art and a science. How do you quantify sentiment from news articles? How do you extract meaningful signals from satellite photos? This is where domain knowledge and creativity meet data science. It's not just blindly feeding data into a model, it's crafting the right questions, the right features.
Human expertise guiding the machine.
And Janssen provides practical Python code using libraries like Pandas, scikit-learn, TensorFlow, showing you how to implement various models and work with both traditional and alternative data. He also touches on using cloud platforms for scaling backtesting and deployment.
So a bridge from theory to actual Python implementation.
Yes, very much so. And that leads nicely to our final book in this initial 20, Python for Algorithmic Trading, From Idea to Cloud Deployment by Yves Hilpisch.
Another practical Python guide. How does it differ from Janssen?
Hilpisch provides a very complete end-to-end framework. His most actionable insight is demonstrating how to build the entire pipeline, from idea to automated cloud deployment, leveraging affiliate vectorized backtesting and broker APIs.
So the full stack for an individual algo trader.
Exactly. He emphasizes vectorized backtesting using libraries like Pandas and NumPy. This is way faster than traditional loop-based backtesting, which is crucial because speed of iteration testing ideas quickly is critical in strategy development.
Faster feedback loops.
Right. Then he shows the practical steps of connecting your Python algorithms to live markets using popular broker APIs like interactive brokers or ONDA for fully automated execution.
Taking the strategy live.
He even gets into the technical weeds of things like socket programming for handling real-time streaming market data, which is essential if you're building lower latency strategies.
So it really closes the loop from concept to testing to live, automated trading in the cloud.
Precisely. It shows you how to take a theoretical idea and build a fully operational, potentially scalable, automated trading system using Python as the core tool.
Okay, so those 3 ML books offer a progression. DePrado for the rigorous foundation and pitfalls, Jansen for practical ML models and alternative data with Python, and Hilpish for building the complete end-to-end Python trading system.
That's a great summary. They really cover the spectrum from high-level theory to hands-on implementation in the ML space.
What's fascinating here is how these books provide not just the concepts, but the actual tools and methods, the code, the frameworks to empower individuals to build sophisticated, data-driven trading systems in a way that just wasn't possible, say, 15 or 20 years ago.
It's a different world. Okay, so that wraps up our foundational 20 books. We've covered a massive amount of ground, from Livermore's Day to modern machine learning.
A huge journey already.
But the world of trading, especially systematic and algorithmic trading, it just doesn't stand still, does it? It's constantly evolving.
Constantly. New data, new techniques, new market structures.
So now we're diving into the next 10. These are books published after 2009, and we specifically chose them because they offer insights and techniques tailored for today's modern markets. They give you that extra edge.
Right. These are critical because they address the landscape after the 2008 financial crisis, the explosion of alternative data, huge leaps in machine learning capabilities, and the increasing institutionalization of quant strategies.
They often provide more practical, updated implementation details too, reflecting the tools available now.
They build on the foundations, but give you that contemporary perspective needed to compete today.
Exactly. So let's kick off this next section with books that really redefine the modern quantitative framework, pushing beyond the basics. We're talking factors, advanced ML, and the power of alt data.
The cutting edge of quant thinking.
First up is Asset Management, a systematic approach to factor investing by Andrew Ng, published 2014. This book represents a major shift in thinking about portfolio management.
Moving beyond just asset classes like stocks and bonds.
Precisely. Ng argues that traditional asset classes are just bundles of underlying risk factors. His key insight is that an asset is a bundle of factors. True portfolio management means systematically managing your exposure to these underlying risk premiums.
Okay, what are these factors?
Think of things like the value factor, cheap stocks tending to outperform expensive ones, the momentum factor, winners tending to keep winning, size, small caps tending to outperform large caps, low volatility, quality. These are persistent, academically documented drivers of return across asset classes.
So instead of just deciding 60% stocks, 40% bonds, you think about how much exposure do I want to the value factor, the momentum factor, etc.
Exactly. You deconstruct returns into their fundamental drivers. And Ng makes a powerful point. Factor premiums are compensation for enduring bad times. You get paid for holding these factors precisely because they go through painful drawdowns when others can't or won't hold them. Your edge comes from identifying which risks you can tolerate.
Knowing your own capacity for pain, essentially.
And here's the kicker. Ng argues that many active managers are essentially just providing expensive, perhaps unintentional access to these well-known factors.
Ah, so you might be paying high fees for something you could replicate more cheaply yourself by directly targeting factor exposures.
That's the implication. By understanding factor investing, you can build portfolios more scientifically, based on data and evidence, and potentially achieve similar or better results than complex, opaque hedge fund strategies, often at lower cost. It's a rigorous, data-driven approach.
A paradigm shift from traditional asset allocation to managing underlying risk drivers. Very powerful.
Very. Okay, next in this modern framework, we circle back to Ernie Chan with machine trading. Deploying Computer Algorithms to Conquer the Markets, 2017. This is his advanced follow-up.
Building on his earlier books, but reflecting newer developments.
Exactly. Chan's key contribution here is providing practical guidance on leveraging newer, more accessible platforms and, crucially, offering cutting-edge techniques specifically designed to reduce overfitting in ML strategies for individuals.
Overfitting is the bane of quant trading. Models that look great on past data but fail live.
It really is. Chan dives into more advanced time series techniques relevant now, like VAR, vector autoregression, and state space models, but always with an eye toward how smaller players can implement them using modern tools like Python libraries. He provides specific, actionable methods to help ensure your ML models generalize well to unseen future data, making them robust for practical deployment.
So bridging the gap between complex theory and deployable reality for the non-institutional trader.
Yes. And he also offers an expert's perspective on the business side, the operational realities, the infrastructure needs, the management required to actually run a proprietary trading operation, even a small one. It's not just about the code.
The whole package.
Yeah.
Important practical considerations.
Definitely. Now, for our last book in this segment on the modern quant framework, something really groundbreaking, The Book of Alternative Data, a guide for investors, traders, and risk managers by Alexander Denev and Said Amen 2020.
This defines a whole new field, really.
It does. The key insight is stark. Alpha, or edge, is increasingly found in better, unique data sources, not just in having better models applied to the same old commoditized data. Traditional financial data, prices, volumes, fundamentals, is available to everyone. The real hunt for an edge is now in novel, proprietary information.
The examples you mentioned earlier, satellite images, credit card data, web scrape.
Exactly. Things that give you a glimpse into economic activity or sentiment before it's reflected in traditional market data or official reports. This book provides a comprehensive, structured framework for the entire alt data pipeline.
What does that pipeline involve?
It covers everything: discovering potential data sources, acquiring the data, which can be complex and expensive, the absolutely crucial cleaning and processing stages — alt data is often very messy — and then finally extracting meaningful trading signals.
It sounds challenging.
Immensely challenging. And the authors don't shy away from that. They provide concrete case studies of how different types of alt data have been used to generate signals, but they also highlight the significant legal, ethical, and infrastructure hurdles.
Like privacy concerns with certain data, storage costs, the need for specialized data science skills.
All of that. It's not easy. But this book is the definitive guide if you want to understand how this new frontier of data is reshaping investment and trading. It shows where the informational edge might lie in the future.
So these three books really push the boundaries. Ang redefines portfolio construction with factors. Chan brings advanced ML techniques down to earth, and Denevan map out the wild west of alternative data, a truly modern quantitative landscape.
Absolutely. Okay, now we move into books offering deep, practical guidance on developing, testing, and managing sophisticated trading systems, moving firmly from theory to battle-tested application.
Getting into the nitty-gritty of system building?
Right. First here is a true heavyweight. Trading Systems and Methods, 6th edition, by Perry J. Kaufman, 2019. This book has been around in various editions for decades, but the 6th edition is a major update.
It's often called the Encyclopedia of Systematic Trading.
That's a perfect description. Its key insight is its sheer comprehensiveness in covering indicators, systems, and robust testing, effectively bridging classical technical analysis ideas into statistically sound, quantifiable rules. It's exhaustive.
So it takes concepts that might be intuitive or visual and helps you formalize them.
Exactly. It provides incredible detail on hundreds of indicators and trading system components, with updated examples and code. Crucially, this edition has extensive new material on things relevant today, like HFT nuances, statistical arbitrage, game theory applications, and even AML techniques integrated into systems.
And it covers risk management in depth, too.
Yes, expanded coverage of sophisticated risk models, moving beyond simple stop losses to portfolio-level risk control, position sizing, and diversification benefits. It's a reference you'll constantly go back to as you build and refine systems. It provides the building blocks and the testing frameworks.
Foundational reference for the system builder.
Definitely. Next, a very different feel, much more practitioner-focused, Building Winning Algorithmic Trading Systems by Kevin J. Davey, 2014. Davey is a 3-time real money trading champion.
So practical advice from someone who's actually done it successfully.
Exactly. And he's refreshingly honest. His most critical insight is that rigorous, unbiased testing, particularly using walk-forward analysis and Monte Carlo simulation, is the key differentiator between professional system traders and amateurs.
Why those specific techniques? What do they solve?
They combat overfitting and give you a realistic picture of potential performance. Davey bluntly states that most trading ideas fail in live trading, not because the core idea was terrible, but because the initial backtesting was flawed or over-optimized.
Curve fitting again?
Right. Walk-forward analysis mimics real-time trading more closely. You optimize the system on one chunk of historical data, then test it out of sample on the next chunk, then re-optimize and repeat. It simulates adapting the system over time, preventing you from fitting to the entire data set at once.
More realistic than a simple backtest over the whole period.
Much more. And Monte Carlo simulation addresses the fact that one historical equity curve is just one possible path. By running hundreds or thousands of simulations, randomly shuffling trade orders, or using statistical bootstrapping, you get a distribution of possible outcomes.
So you understand the potential range of drawdowns, the likelihood of ruin.
Exactly. It helps you grasp the system's true risk profile and prepare psychologically for the inevitable rough patches. Davey also emphasizes position sizing and portfolio diversification, combining multiple uncorrelated trading systems as crucial for managing overall risk.
Practical, robust testing is the real edge, he argues.
That's his core message. The development process itself is where the value lies.
Makes sense.
Yeah.
Okay, another practical guide.
Yes, trading evolved. Anyone Can Build Killer Trading Strategies in Python by Andreas F. Klenow, 2019. This one is very code-centric.
Klenow also wrote Following the Trend. He's known for practical Python applications.
He is. His key insight here is demystifying the process of setting up a professional-grade backtesting engine using Python and providing full open-source code examples for complete strategies. He empowers you to build your own transparent system.
Moving away from relying on black box trading software.
Exactly. He argues that building your own engine, even a relatively simple one, gives you far greater understanding, flexibility, and trust in your results. He provides the Python code to do it, showing examples for common strategies like trend following on futures.
Learn by doing with replicable code.
And importantly, he takes a very realistic, no-hype approach. He shows the actual, sometimes messy, performance of these strategies, including significant drawdowns. No get-rich-quick promises here.
Transparency about the realities of systematic trading.
Yes. It's a perfect sequel, really, for anyone who's learned the basics of Python from a book like Hilpisch's and is thinking, okay, how do I actually build and test a real trading strategy now? It bridges that gap.
Very valuable for the aspiring individual quant.
Definitely. Okay, final book in this deep dive systems section, Statistical Arbitrage, Algorithmic Trading Insights and Techniques by Andrew Pohl, 2011. This one is unique.
StatArb, a notoriously competitive and complex area.
It is. And Pohl offers a rare inside look. The key insight is twofold. He provides a clear conceptualization of the complex mathematics behind short-term strategies like pairs trading, but also candidly chronicles the 2007 quant quake as a visceral lesson in model risk and overcrowding.
So the theory and the harsh reality.
Exactly. He dives into the statistical rigor needed cointegration, Kalman filters, etc., for strategies that exploit tiny, fleeting price discrepancies, often based on mean reversion.
The sophisticated math for very short-term edges.
Right. But then he recounts the infamous quant quake of August 2007, where numerous sophisticated, supposedly uncorrelated quantitative funds, many running similar statistical arbitrage strategies, suffered massive simultaneous losses.
Why did that happen?
It's believed a large fund rapidly unwinding positions forced widespread selling in commonly held quant stocks, triggering margin calls and losses across firms using similar models and factors. It exposed hidden systemic risks and the dangers of assuming correlations remain stable, especially under stress. Overcrowding was a huge factor.
A critical cautionary tale about model risk, leverage, and unexpected correlations.
Absolutely. Pohl provides a practitioner's view on the real-world challenges. Transaction cost eating edges, signal decay, the constant need for research, balancing the elegant theory with the gritty reality of running a StatArb portfolio based on his own experience.
A deep dive into a specific, sophisticated strategy, warts and all.
Exactly. So this section has taken us from Kaufman's encyclopedia through Davies' rigorous testing, Klenow's practical Python builds, to Pohl's deep dive into StatArb and its risks, really focused on building and testing robust systems.
Yeah, a definite shift from just understanding concepts to the practicalities of building, rigorously testing, and managing live trading systems.
Okay, prepare for another shift. This next section takes us beyond traditional trading psychology into the actual biology and neuroscience of performance, risk, and decision-making.
Whoa, okay. This sounds different.
It is. This is truly proprietary information, I think, for optimizing your human edge as a trader, understanding the wetware itself.
Intriguing. What's the source?
The book is The Hour Between Dog and Wolf: Risk-Taking, Gut Feelings, and the Biology of Boom and Bust by John Coates, 2012. Coates is fascinating. He was a derivatives trader on Wall Street, then left to become a neuroscientist at Cambridge studying traders.
Trader turned brain researcher. That's a unique perspective.
Incredible perspective. He explores the biology of risk-taking, arguing compellingly that our physiological responses, particularly hormones, actually drive market booms and busts and individual trader behavior.
Hormones influencing market cycles. How?
His core insight is that your physical state, fitness, sleep, stress levels, is absolutely critical to your mental performance because hormones like testosterone and cortisol directly impact risk appetite and rational thought.
Okay, break that down. Testosterone first.
Coates presents evidence for the winner effect. When traders are on a winning streak, their testosterone levels can actually rise. This boosts confidence, encourages risk-taking, which can be good up to a point.
But can lead to overconfidence, hubris, taking reckless risks.
Exactly. The biological feedback loop can push traders towards excessive, potentially disastrous risk-taking during winning periods. They feel invincible.
And the flip side, cortisol.
Cortisol is the stress hormone. When traders face losses, market crises, or high uncertainty, cortisol levels spike. This has known effects on the brain. It can impair rational decision-making in the prefrontal cortex, narrow focus, and induce risk aversion or even panic selling.
So stress makes you dumber and more likely to freeze or sell at the bottom, basically.
That's the biological reality Coates highlights. This means, practically, traders need to manage their physiology rigorously. Treating your body like a high-performance machine isn't a luxury. It's fundamental to maintaining peak cognitive function and emotional control.
So exercise, good sleep, stress management techniques, they directly impact your P&L.
That's the argument. They help regulate these hormonal responses, keeping you closer to an optimal state for decision-making. He also has a fascinating take on intuition or gut feelings.
Not just mystical feelings.
No. He argues intuition is the brain's incredibly rapid pattern recognition system, informed not just by experience, but also by subtle physiological cues from the body's somatic markers. Mastering this requires being attuned to your body's signals, which again links back to managing your physical state.
Wow. That provides a deeply unique perspective on trader performance, integrating biology directly with psychology and decision-making. It's not just mind over matter, it's mind and matter.
Exactly. A truly fascinating and actionable layer to understanding trader behavior and optimizing your own edge.
Okay, that's a mind bender. Where do we go for our final section?
We conclude our deep dive with two powerful memoirs and narratives from legendary figures. These books apply timeless wisdom, but place it squarely within the context of the modern financial era. They bring the theories and the history to life through personal stories.
Stories of success and caution from the modern era.
Precisely. First, we revisit Scott Patterson with The Rise of the Quants, how a new breed of math whizzes conquered Wall Street and nearly destroyed it, 2010.
We touched on this regarding HFT, but it covers the earlier quant pioneers too, right?
It does. This book provides a narrative history of the key figures and firms, people like Ed Thorpe, Fisher Black, Myron Scholes, Robert Merton, the founders of firms like D.E. Shaw and Renaissance who pioneered quantitative finance. Its key insight is explaining that fundamental transition from human intuition-driven trading to model-driven systematic trading.
How the rocket scientists took over Wall Street.
In many ways, yes, but Patterson doesn't just celebrate them. He uses the spectacular failure of long-term capital management, LTCM, in 1998 as the ultimate cautionary tale about model risk, hidden leverage, and flawed assumptions.
LTCM had multiple Nobel laureates on board, right? The smartest guys in the room.
They absolutely were, and their complex arbitrage models worked brilliantly until they didn't. The Russian debt crisis and subsequent market turmoil exposed unexpected correlations and liquidity vacuums that their models hadn't accounted for, leading to near-catastrophic losses and a massive bailout orchestrated by the Fed.
A vital lesson against over-reliance on models, assuming markets are always rational, and especially against excessive opaque leverage. Hubris kills.
Exactly. LTCM is the ghost that still haunts quantitative finance. Patterson's book provides crucial context for the quant revolution, showing how these pioneers shaped today's market landscape, but also highlighting the human element, the personalities, the egos, the rivalries that played a huge role, even in these highly quantitative fields.
History providing essential lessons. Okay, who is our final author?
Our final book, number 30, is the memoir of one of those pioneers himself, A Man for All Markets. From Las Vegas to Wall Street, How I Beat the Dealer and the Market by Edward O. Thorpe, 2017.
Ed Thorpe. The man who literally wrote the book on beating blackjack, beat the dealer, and then applied math to markets. The godfather of the quants.
He really is. His memoir is fascinating. The most profound insight, I think, is the universal applicability of his single core principle, learned first in casinos. Find situations with a quantifiable positive expectation, plus EV, and then rigorously manage your bankroll to survive the inherent variance.
The same principle works in blackjack and in warrant arbitrage.
Exactly the same logic. Thorpe was a master at identifying and quantifying market inefficiencies where others just saw randomness. He developed the first wearable computer to beat roulette, though never deployed it at scale, figured out how to price options before black schools, keeping his formula secret, and pioneered statistical arbitrage techniques, particularly in convertible bonds and warrants.
Always finding a quantifiable edge.
Always. And crucially, he stressed the importance of knowing the precise size of your edge for optimal position sizing, often using the Kelly criterion, which he independently derived and used extensively. Mathematical precision informed his practical betting and investment strategies, maximizing long-term growth while minimizing risk of ruin.
Connecting the math directly to the money management.
Perfectly. His entire life story is a testament to the power of independent, objective thinking, rigorous quantitative analysis, and refusing to accept conventional wisdom. He relied on first principles thinking and demanded mathematical proof, challenging assumptions everywhere from the casino floor to Wall Street.
A truly inspiring figure for anyone interested in applying quantitative methods. He literally invented ways to find edges others couldn't even conceive of.
He did. A perfect capstone to our journey through these 30 books.
Yeah, these narratives from Patterson and Thorpe provide that crucial historical context and highlight the enduring lessons, the power of quantitative thinking, but also the dangers of hubris and model risk, all told through compelling stories.
So, what does this all mean? Wow, we've covered a lot of ground. We've just navigated a curated library of 30 essential books.
Like the marathon.
It really was. And we've tried to pull out the most impactful, the most actionable, the most unique insights for your trading journey.
From timeless market psychology with Lefebvre and Douglas,
To the rigorous testing of Davy and Kaufman.
the market microstructure of Harrison O'Hara,
The biological insights of Coates.
all the way to cutting-edge factor investing with Ang and machine learning with DePrato, Jansen, and Hilpish.
The common thread, I think, is clear throughout all of this. It's continuous learning, it's rigorous testing and validation, it's adaptability, and maybe above all, it's a relentless focus on process over short-term outcomes.
Discipline and process.
These insights, taken together, represent a really powerful foundation. We hope they offer you, our listener, a significant shortcut to deeply understanding what drives success in today's complex markets. We genuinely hope you feel you've absorbed, close to that 95% of the core value from these incredible resources today.
And remember, as we said at the start, this deep dive, it's really just the beginning. Listening is one thing, but the real value, the transformation, it comes from applying these insights, from actually doing the work.
Absolutely. It's about integrating these ideas into your own approach.
So maybe a final thought to leave you with. Consider this. We live in an era of information overload, right? Data is everywhere. Models are getting more complex. But maybe your true edge won't come from just more data or even more complex model. Maybe the real durable edge lies in your ability to synthesize information like this, to critically evaluate it, and then, most importantly, to consistently execute on the fundamental, often timeless principles revealed across all these diverse fields we've discussed.
That's a powerful thought. It's not just about knowing more, but about integrating and executing better.
Exactly. So the question for you, the listener, is, based on everything we've unpacked in this deep dive today, what's the one aspect of your trading rhythm? Maybe your psychology, your risk management, your system testing, your data analysis. What's the one aspect you're going to focus on transforming first?
A great question to ponder.
We really encourage you to revisit specific sections of this discussion, or maybe even pick up one or two of these books that really resonated with you and start applying those key insights. That's where the mastery truly begins.